Local stories, local voices. We're localwebradio.fm.
Welcome to Sound Investing with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy, and recognized by Vancouver Magazine in its selection of top wealth makers in Vancouver for 2013. And now, here's your host.
Yes, this is your host, Eric Reynolds, and I'm here with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy. And today we'll be talking with Byron about demographics, the simple secret to predicting our economy. Now, before Byron joins us, just a reminder that if you have questions or require assistance, you can reach Byron at 604-535-3700. That's 604-535-3700. Hi, Byron. It's great to be talking with you today.
Hi, Eric.
Now, Byron, in the last episode, we talked about investor behavior, and today we'll be covering demographics. Give us a brief description of what demographics means.
Basically, there are two parts to investing. There's what you do as the investor, and then there's what the economy does. And there's no denying that a strong economy in general will help investments, and a poor economy will work against most investments. But unfortunately, it doesn't always line up nicely between what the investor intends to do and what the economy actually ends up doing. So for the most part, that's what makes investing risky. And because the majority of investors and economists do not have the tools to make accurate economic forecasts, that's why I work with Harry Dent, who pioneered economic research into demographics. And basically, that's the study of people. And it's the study of how people drive our economy as they move through it, of course, in generations, as they move through the economy with very predictable spending cycles. And I've always used the example that here in White Rock, I mean, if all of a sudden, if you think of it this way, if all of a sudden the population of this town doubled overnight, okay, what would the impact be on merchants in town? Well, it would be a very positive impact because there'd be so many more people to do business with. On the other hand, if the consumer population halved overnight, it would make it harder on the merchants because there'd be less consumers to do business with. And that's basically what demographics tries to illustrate for us, is there are times when there are larger generations moving through the economy, and of course times when there are smaller generations, and each one of them will have an impact on the market. A larger generation will have a larger economic impact, and a smaller generation will have a smaller impact. And of course that impact will flow through to the stock markets, and of course that, and the financial markets, and that's what we're most interested in. So as a result, Harry has developed some very accurate forecasts of how our economy has and will change over time. And for me, that helps me, for my investors, make better informed decisions, for their investment decisions. So from a demographic viewpoint, and contrary to conventional thinking, long-term trends are very fundamental. They're actually cause and effect driven, and that makes them projectable for actually decades out with a very high degree of accuracy. It's actually the short-term trends in the market that are driven by political events and swings in investor psychology, like, for example, fear and greed. This is short-term events that are hard to predict. So most experts will focus on these trends and then come to the belief that long-term trends are impossible to predict precisely because their experience with short-term trends is so poor. But I'll actually give you an example of how this works over a larger time frame, and then as we go forward, I'll bring it down. But to give an example of how demographics work in our modern economic era, and we sort of define the modern economic era as being the last 100 years or so, certainly after the Industrial Revolution. So if we take the 19th century, since then, there have been three major generations that have moved through the economy, and we characterize those as the Henry Ford generation, the Bob Hope generation, and of course the baby boom generations that is currently moving through today. Henry Ford, their generation, which was a large generation, drove an economic boom from 1902 to 1929. So we had 27 up years, and then we went into the Great Depression from 29 to 32 for 13 down years. So there we had that classical 40-year generation, and I probably forgot to mention that most generations take about 40 years to move through the economy. So picking up in 1942, we had the Bob Hope generation, which came in, and they were entering, like the Henry Ford generation, they were entering the workforce, starting up the income ladder, and that's when they start driving the economy. They drove an economic boom from 1942 to 1968 for 26 years, and then we had a recessionary and inflationary economy throughout the 70s from 68 to 1982. So there we go, another classical 40-year sort of chunk of time. And, of course, currently, here we are with the baby boom generation, which has basically driven this entire boom from 1982, and we feel it peaked out in 2008. Whether or not the markets have peaked, certainly the spending, the massive consumer spending, which from 82 to 2008 was increasing every year, and around the late 2007 and 2008, that has leveled off and is starting to go in decline right now. So our outlook, of course, we're a little bit more cautious, coming into the next decade right here. But the great thing is that, from my point of view, as I look at this information, we can see that investment trends are largely predictable because demographic trends have already set them in motion.
So like the demographics of unpredictable markets and unpredictable investors are pretty predictable when you lay it out over time, I guess, is what you're saying.
Absolutely.
Okay.
So I try to take this information, and this is, I referred in the first show to what I called a forward-looking strategy. I use this information to develop a forward-looking strategy that will benefit my clients in periods of economic change. First of all, by recognizing and taking advantage of opportunities during economic upturns, and secondly, by protecting their investments during downturns. So, when this is combined with developing an objective view of the market that I help my clients develop, hopefully this will stop all of us from making the same knee-jerk emotional reactions as the herd. And what I'm trying to do is build a foundation for long-term success for my clients, and believe me, peace of mind for both of us.
Well, we're up against a break, but we'll be right back with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy.
More Sound Investing with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy, after this.
Shopping for the lowest mortgage rate? Looking to refinance? Catch Jared Dreyer in the Mortgage Lab on localwebradio.fm.
Are you struggling with a dental or oral health issue? Dr. Norm Ickert from Ickert Dental Implant Center is committed to improving your quality of life with the very best in modern and advanced dentistry. you can catch Dr. Ickert on the Health Channel for the Healthy Smiles Oral Health Show here on localwebradio.fm and at the Ickert Dental Implant Center in Langley at 866-981-1381. That's 866-981-1381.
Buying or selling a home on the Semiahmoo Peninsula? Catch up on local market conditions on This Week in Real Estate with Lance and Connie Marples from Sutton West Coast Realty on localwebradio.fm.
It's now time for more Sound Investing.
Well, I'm here with Byron Striloff, and we're discussing demographics. Now, Byron, how does it differ from the way the financial industry in general provides forecasts for the economy and financial markets? You know, after all, we all want to know what the markets are going to do next.
Yes, that's actually something we certainly all want to know what's going to happen next. But here's the interesting thing. For as much as economic activity over the past century has become important to us. I mean, commerce and investing has always been a part of modern civilization, but it's really become a dominant concern because today economic activity is so directly correlated with our standard of living. And of course, everybody wants to have, a good standard of living. But strangely enough, like other forces that we've learned to predict, and I guess I think of the weather, for example, we haven't done as good a job on markets or the economy. And again, this is something truly we would like to have a better idea, because the more we can predict and the more accurate those predictions are, the more we can manage to reduce the risks or uncertainties in financial markets, and of course, therefore, we got a better chance of increasing our standard of living.
Well, Byron, it's kind of like if I want to wear a sweater today or a short-sleeve shirt. I want a pretty good prediction or a pretty accurate forecast in the same way with our financial forecast, right?
Well, it's interesting you actually bring that up, because none of us would ever worry if we're traveling to Texas what clothes we have to pack, because we certainly can rely pretty much on the weather forecast.
Yeah, down there, absolutely.
So why is it that as some areas have become easier to predict, economics and economic change actually seem to have become harder? And the way I've certainly seen it, and even more so over the last 10 years or so, is that in our business, okay, we're barraged with economic data to help us understand current activity and as well as they help us try to look into the future. As advisors, we read about currency exchange rates, trade imbalances, interest rates, inflation projections, unemployment numbers, and then we've got hundreds, if not thousands of different analysts who take all these factors and they put them into their little quantitative models and spit out estimates of change in our economy. And you know what? They're wrong. and more so, no one cares.
Right.
And the reason no one seems to care is we've become so accustomed to the lack of accuracy in forecasting any economic change. So really, most people end up considering it to be impossible. They feel that there's too many variables, they change too fast, they can't accurately measure the current economic state, never mind trying to forecast what any future changes will be. And I think there's a reason that this perception exists, because the study today completely misses the driving force of our economy, or in fact of any economy to that degree. And let me give you an example of what I mean here.